All right. Well, listen, mortgage rates are finally back at about 7%. They have fallen almost 80 basis points in the last 6 weeks as a result of the 10-year Treasury yield dropping below 4.2%. And as we continue to see mortgage rates fall, purchase applications continue to rise week over week over week over week, which is exactly what we thought would happen by the end of the year as we get into 2024. And so with me to discuss this and more, Mr. Steve Frost from National Mortgage Funding. How are we doing, my friend?
Pretty great, man. How are you?
Doing well. Doing well. So jobs reports comes out, right? Things are happening that, reflect in these mortgage rates dropping. What are you seeing? Like, how far do you think mortgage rates can continue to fall? And do you feel like the worst is behind us?
So part of me thinks that, yeah, I do. But if you remember last year, we had, it's like sorry for the echo in here, by the way. I'm just now picking it up that there's absolutely no I'm in a closing room in a different office today. I'm realizing there's no fabric on the walls to absorb noise.
All good.
But anyway, yeah. So we went through this last year. If you remember, I mean, we had rates below 6% for a short period of time. And then they started what turned into this like meteoric rise to these like 20-year highs. So, it'll be interesting to see how things progress. We've had a lot of positive news as far as inflation goes, and as far as employment markets, labor markets starting to soften, which is what we were really looking for. I think today's jobs report was a little bit of a misnomer. I think that some of the data inside that is probably a little bit misleading. So, rates, like you said, rates have come down between 80 and 100 basis points in the last 6 weeks, which, normally I always say that, rates take the elevator up and the stairs down. And really, this has been a pretty significant decrease in rates. And we're still seeing that large spread between the 10-year Treasury and the 30-year fixed. So, I'm hesitant to say that we'll continue to see them drop. I think that, if you look at a lot of data, they were thinking that this should be the range that the 10-year Treasury trades in, should be in this 4.25 range, is very restricted. We didn't need to get as bad as we were. So, I think we'll probably hang out in this range for longer than a lot of people. I'm a little bit more, I'm more in the gonna stay here a while crowd than I am going down further. And that's just because, the employment numbers aren't that bad. Unemployment claims are staying pretty low. So what that means is that, the Fed is a dual mandate, right? The Federal Reserve is to manage inflation and also manage employment numbers and keep people working. And so right now our economy is growing, inflation is meaningfully decreasing, and they're keeping America working at the same time, which for them is a good thing. There's no reason for them to start cutting rates yet, because they can continue to tackle inflation and still have the economy stay out of a recession. So in my opinion, as much as I'd like to see them come down, I don't think we'll see like another big meaningful drop until probably a little bit later in 2024.
That's interesting. Yeah. I mean, that is interesting too. Because, most people believe that the Fed's going to cut interest rates 4 times in 2024. And just because as a result of many, many things, but the labor market being one of them. But you're under the belief that even if the Fed starts to cut rates in 2024, like it's expected to happen, that you think mortgage rates will still hover right around 7%.
Yeah, I do. I don't see them dropping as aggressively. A lot of the market right now is pricing in that the Fed's going to start dropping rates in March at their March meeting.
Yep.
I do not think that's going to happen. I think that this Fed they're going to look like a real bunch of dipsticks if they end up cutting rates too soon, especially when they let inflation get as high as they did. But keep in mind that for mortgage rates to change, we don't need them to cut rates. All we need is the Fed to say we're satisfied with our current policy position, and we can start to pivot our meetings and our conversations towards the next phase of the cycle. As soon as that happens, we're going to see that spread between the 30-year fixed and the 10-year treasury go down. So that will change in itself and keep all the other rates high. So that part of this will happen before they start to cut rates, as soon as they have that conversation. So yeah, will we see, there's more of a better chance of rates going down in the near term than there is going up. However, I don't think that this Fed is particularly motivated to start cutting rates because of the jobs numbers looking the way they are. The unemployment numbers look fine. And we had really good growth in Q3. So we'll see what Q4 looks like. But Q3 blew it out. We had a great third quarter, which was predating to what we're now seeing, a lot of these inflation growth rates dropping. So yeah, rates are poised to go down. I don't think it's going to be a big drop. It would be nice to stay in this range and then just take little chunks as we go. But it's just, these cycles are unpredictable in that way.
Yeah, I mean, it could be possible that this Fed has scared you in being more skeptical of rates dropping. And maybe the tone, like, have you lost trust in this correlation between the 10-year yield and the 30-year fix because we've never seen this before?
Well, the spread is high because the Fed hasn't had to have the tone that they've had for the last three press conferences. They have done their job, and this Fed is hell-bent on not letting these markets get excited about getting out of control and decreasing the cost of money. And what happens is when the 10-year starts going down and those things contract, right? The spread between the 10-year and the 30-year fixed, is that's easing monetary policy. And these guys are not in the business of letting the markets determine their policy. They're in the business of running that show themselves. And so, look, I mean, I want rates to go down as much as the next guy, but you have to think that what their goal is to reduce inflation and be able to still have the GDP grow. And if our economy is still growing and people are still working and we're still working through these higher rates, that's a real wrecking ball for inflation. So the longer they can keep this policy the way it is, the bigger impact it's ultimately going to have on inflation.
Because that's the whole soft landing they've been talking about.
Yeah, I mean, exactly. I mean, there's so many recessionary indicators, and they've all been there for the last 6 months, and it hasn't hit a job market. And does there need to be a massive job loss recession? No, but we should see more than what we are. Yeah. I will tell you though, when you look at the jobs report that we saw today that came back at 199,000, a lot of those jobs, the market kind of shrugged that off because a lot of those jobs, you had the UAW strike. Everybody went back to work. And while those people didn't lose their jobs, a lot of the ancillary companies did have to lay people off while they weren't working. And then you also had the SAG actors or guild strike thing, for the movie makers and all that. Yeah. All those people went back to work and all those supporting roles went back to work and made a big difference. So that's one. The other part of this jobs report that's a little wonky is that the other two leading sectors were teachers and healthcare. And who pays for teachers and healthcare? The government.
Sure.
That's not paid for by anybody that's private. That's the majority of that pay comes from municipalities for teachers, and it comes from the federal government through Medicare, Medicaid, and all those things. So if you pull those jobs out of those numbers were dismal. So again, for me, I'm like, am I a skeptic? Have I lost some faith? No, but part of me is like, okay, now we're coming up on an election year and we have all of these government jobs or the government supporting all these job increases to look like, hey, we're still hiring and things are booming. But at the same time, when you look at what some of these numbers are, it's not that exciting, So it'll be interesting. I think we'll learn a lot next week when the Fed talks. We should see a hint, the Fed statement, I think will remain very much the same. I think we'll see just a little bit of a softening of their tone, which should be nice and should be a good rally for the markets.
Yeah, and here's the other thing too. I mean, even if the 30-year fixed hangs out in the high sixes, if there's a 6 involved, I believe that purchase mortgage applications will continue to grow, which is what we need for 2024, is that demand to kind of come back. Home prices have stayed stable, as you know. And so is that what you're seeing? And do you believe that will be the case?
Yeah, for sure. I'm already seeing it. We've had our November was our best month of the year. December is not going to be a slouch either, which is usually,
It's huge.
seasonally a slower month, and it's been great. Let's talk like realistically, right? So you think about like, hey, we saw mortgage rates are 7.03 as published through MBS Live. Back there were times when I was pricing out loans at like 7.99%, paying a point and a half, and me discounting cost to get you there. And I locked a loan today at 6.625 with a point.
Wow.
So that's less cost for 1.375 lower in rate. And so if you look at the real math on that, every $100,000, that's talking about $150 a month. So your $300,000 loans are now $450 less a month than they were 8 weeks ago.
It's incredible.
So, I mean,
say that one more time. So hold on. I just want the audience to catch what you just said. I mean, that's the whole idea. Yeah.
So looking at it from a Main Street perspective, right? If we're comparing like 8% to a 6.625 today at roughly the same cost, the way I do that math is that 0.5% on a $100,000 loan is about $41 a month, right?
Okay.
So if you're saving 1.375%, let's just call that $130 a month in savings for every $100,000. So my math was off on 300. It's $390 a month, whatever it is. You're talking, that's huge.
It's massive.
If you're thinking if you look at the average purchase price for a new home in the United States right now is like $409,000. I mean, you're talking $80 less for every 100K right now, based on what these rates are doing, and that's being conservative. So that's some big numbers. You're several $100 less a month, which is a meaningful impact, and that's really nothing new happening in the market other than like a slight softening in the labor market. That's all that is. That's not the Fed saying anything new.
Right.
That's inflation is moving down bit by bit. That's not anything major. And it's still with that same spread on the 10-year. So yes, there's a lot of room for rates to move lower, but when you're driving a lot of this stuff by, government-based, and I'm not being one of these anti-government people either, but when the government influences a lot of these reports and things that we look at, and you're coming into an election year, it just gets kind of funny. That's all.
Yeah, but that's a really good point. I mean, even so, where we currently are pricing these loans out, you talk about affordability, right? That's been the biggest challenge for demand for buyers. And now there's that perspective we've been talking about for about a year, right? The perspective that these buyers been shopping for homes, going back to your point, $400,000 being the average price point. And now that same property in 2024, in this home buying season, when we get to March 2024, and that potentially being $450, $500 less per month. I mean, this is why I believe that real estate transactions sales will increase by 1 million. We'll come out of a 4 million sales this year in 2023, huge, massive devastation to transactions, and that should increase because of demand. As a result of that, I do believe that we still will probably see home prices increase yet again. What are your thoughts on that, on next year's kind of predictions?
Yeah, I think so too. I think that, we're going to ideally that'll open up more, I don't want to say inventory, but you're going to get some of the move ups, right? You're going to get people that are going to start swapping out some of those ultra low rates, especially when they can sniff a 5 rather than a 7 on the front end of that. So yeah, I do. But at the same time, the statistics say, it was funny, like 2 months ago, it's like for every 1% rates drop, 5 million new borrowers enter the market. I think the new one on social media is it's 8 million borrowers for every 1%, because now we're more excited about it. But that's 5 million borrowers or buyers entering the market for every 1%. So, that I think that, there's builders are not keeping up. Builders have actually new home starts and even new home finishing permits and occupancy certificates have started to decrease really when rates hit their peaks, because that's when it finally hit builders and they started to lose some confidence and things. So we're still not building at enough pace to create supply that will keep the housing market down. We just saw CoreLogic come in this week, was like 4.7 year over year from last year. And that's in the face of the highest interest rates we've ever seen. So your $400,000 home went up by $20,000 this year in the worst market we've ever had for transactions.
Yeah, that is interesting. So
I think Zillow saw like an annualized pace to six, or like pretty much all of the big, like Black Knight, CoreLogic, Case-Shiller all saw 6 to 7% increases in this awful interest rate environment. I think as we see those rates come down, we'll continue to see that growth as much as we don't want to.
yeah, so the Fed's due to meet one more time this year, right? On the 12th?
Next week.
Next week. So talk to us. What do we anticipate happening at that meeting next week? Because that'll be the last kind of hoorah for the Fed and how these markets respond.
Yeah, this one actually has some pretty decent weight to it. So like I said, there's going to be the Federal Reserve's prepared statement that they do after. I think that one will probably see a slight softening in that. As in they're going to say more along the lines with they're happy with the progress of inflation. I think they're still going to say that they want to see a consistent trend in the data to see that inflation, the reduction in the inflation rate is continuing at this pace. They're going to want to see the labor market continue to soften. So it'll be kind of a nothing burger, really. There's a couple things that will happen though. So they will release another dot plot. And so that's going to give each of the governors their prediction of where they see rates next year. And so that'll kind of be, rather than analysts predicting it, it'll show us what the Fed is thinking. And then the Fed is also going to give us their growth projections for next year, which will talk about, the strength of the economy. So, this last meeting of the year is going to carry a little bit of weight, and it'll be interesting to see how it goes. The market is pretty hell-bent on the Fed lowering rates, cutting rates 4 times next year. So it'll be interesting to see how they counter that. Because like I said, as much as that's probably the case, the Fed, the last thing they want is for this market to get excited without them, being the conductor of it.
Yeah, that's a good point. So most likely they're just going to pause, right? They're not going to raise, they're not going to cut next week, right?
No.
Yeah. So it will be interesting. And so that'll be the last Fed meeting of 2023. But anyway, my thoughts is that as we get into 2024, that it is a overall healthier housing market from the standpoint of, I think that inventory will increase slightly. I think that affordability will become better for buyers. And I think that demand will also increase. All of that to say that it will result in a market that, again, I'm predicting we probably end up somewhere around 5 million sales next year, which will be a massive increase coming out of this year, which will probably I don't even know if we'll get to 4 million. We might even end up a little bit less than that. And so I just believe if rates, even if they stayed where they're at, and you're right, and they don't go down like a lot of economists believe that they will, I think that the housing market will be in a healthier spot this time next year than it is right now.
Yeah, it'll be interesting to see. I think another part of this that's kind of like an intangible piece of it is that the interest rate markets have steadied. Like before, people really thought rates were going to go up, and they're worried about like 8, 9, 10%. Am I going to lose my job? What does the future look like for me? And I think that the more people are kind of used to it, and they're still seeing like I think we saw wage growth this last time was right around 4%. So if inflation's growing at just a hair under 4% and wage growth is growing at 4%, people are feeling more comfortable with the cost of living and the cost of housing. And that, I think there's that intangible piece of it is what I really think is driving the market now, that's giving us this little boost here. And the more of that we see, along with some positive rate news, should drive a pretty good 24 for sure.